Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. Happy 2021, welcome to the new year. For our first episode of the new year, but a continuation, episode 116 of the numbers from last year, we're going to look at our second installment in the series on estate planning calculations. And today we're going to dive into life annuity interests. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So, to recap, one quick point I want to make is that in this episode, I'm not going to walk through specific examples, much like I didn't in part 1 when we talked about valuing term or life income interest, because it's hard to stack the methodology and the example in the same presentation given the time limitations. So for the next episode in this series, what I'm going to do is create specific examples for parts 1 and 2. So if you're the type who needs those numbers and needs those steps illustrated in visual numerical form, that's coming down the pike, don't you worry. Now, last time we talked about, as I mentioned, valuing an income interest that's retained for life or for a term of years, and that could even be a use interest in non-income producing property. And as you recall, what we did is we looked to Table S or Table B based on the 75/20 rate and the age of the person who held the interest, and from there we were able to glean the appropriate remainder factor and or income factor. Recall that the remainder factor and income factor for each age add up to 1, and that factor could then be multiplied by the value of the assets in the trust or whatever the case might be to determine the present value of the income interest if you're using the income factor, or the present value of the remainder interest if you're using the remainder factor. Now, today we're going to look at annuities, and we're going to have the same start, but we're going to use a little bit different methodology in terms of which factor we use and how we apply it. Now, I want to preface that we already talked about valuing annuities at death that are retained interests under Code Section 2036. So these calculations are going to be different from Code Section 2036 calculation. So if 2036 applies, if you're valuing, say, an annuity at death, see episode 74 for how you do this. But most of the time when we use this, we're going to be calculating maybe midstream or at formation the present value of an annuity, or we're going to be valuing it at death, but with respect to an annuity that maybe was created by somebody else that isn't subject to Code Section 2036 for whatever reason. Now, when I say annuity, what I'm referring to is a non-commercial private annuity that you typically see created in an estate planning structure. So a classic example for today's presentation would be a charitable remainder annuity trust, or a CRAT. Now, you might be saying, oh, you could use a GRAT or CLAT or whatever too, but these types of trusts often have a term annuity interest and not a lifetime annuity interest. When it gets time to calculate term annuity interest, that's a little bit more difficult. Today we're only focused on a life annuity interest so as to not throw too much at you. Now, we're going to have two tables to be used here potentially. You'll always use Table S, which has single life factors if you're calculating the value of a single life annuity. If the annuity is payable more frequently than annually, you also need IRS Table K, which has annuity adjustment factors. Now, as with the income interest, you'll need the 75/20 rate for the month of valuation, and you'll need the age and birthday of the beneficiary who holds the annuity interest. And that's relevant. You take the age as of the nearest birthday to the valuation date, and that's going to tell you what factors used under Table S, and the 75/20 rate is going to tell you what portion of Table S is used. Now, from there, you're also going to need two more things. You'll need the total amount of the annuity payable annually, and if the annuity is payable more frequently than annually, you'll need that frequency as well. Now, if you have an annuity payable more frequently than annually, you'll add up those payments for the year to determine the total amount that's paid annually. Now, from there, you can dive into Table S, and we're only looking for one number. we're looking for the annuity factor based on the 75/20 rate and based on the relevant age. So, for example, we have here a snippet of Table S for a 0.4% 75/20 rate. So you can see with age 55, actually any age, the first column is the annuity factor. In the last presentation, we looked at the life and remainder factors, but today we're looking at the annuity factor. And you'll notice that's a number much larger than 1. And in fact, throughout the table, it is much larger than 1 until you get up around age 110 or so. Now, with the annuity factor, what that represents is the present value of the right to receive $1 per year for the rest of the annuitant's life expectancy. So for example here, at age 55, if you were to get $1 per year for the rest of your life, the present value of that today would be $24.07. So how do we use this annuity factor? Well, what you do is you take that annuity factor, and assuming there's just an annual payment that you're dealing with, you multiply that times that annual annuity amount we determined back when we were a couple of slides before, and that will give you the present value of the annuity. And with that present value figure too, you can subtract that from the total value of the trust or the transfer or whatever to determine the present value of the remainder. There's no convenient factor to determine the remainder. It's more just taking the present value of the annuity and then backing that out from the value of the trust. Now, before you get to that remainder calculation, once you have your annuity amount multiplied by the annuity factor, you may also have to determine an appropriate annuity adjustment factor under Table K if the annuity is payable more frequently than annually. So you'll see that Table K breaks this down by semi-annual payments, quarterly, monthly, and weekly. And what that's going to do is it's going to give you one and a small fractional figure above and beyond that has a slight adjustment, a slight increase over 1 to the total value of the present value of the annuity based on a more frequent distribution than annually. Now, for other frequencies not in Table K, the IRS does allow you to determine that, with mathematical certainty, but you have to figure that out on your own, and we're not going to really worry about that for this series. But once you have that Table K factor, that's the last missing piece you need to make all the calculations you need using both the annuity factor and the adjustment factor for a lifetime annuity interest. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of the 10th of an Hour, and I look forward to seeing you in the next one.